All right, I want to bring back in Anthony Chan, former chief economist, as well as Sylvia Jablonski, CIO and co-founder of Defiance ETFs. Sylvia, let's start with you. It's great to see you. Let's talk about this report. I mean, we heard Brian and Jared say it was sort of a Goldilocks report with regard to the markets. Do you see it that way?
Yeah, I would have to agree with that. I think that, missing the expectation by just a little bit shows that, things are improving. People are getting back to work. The job situation is getting better. In other words, we are continuing to recover from the pandemic, which allows us to grow as an economy. I think if the number actually beat, it would sort of be the situation that I think would instill some fear in investors and probably pull back the major indices, just because people would then start to think, oh no, the Fed's going to start to taper tomorrow, instead of thinking about it, and rate hikes will come sooner, inflation will come sooner, and things like that. So this kind of, I think, feeds into the story well that, there will be this sort of transitory, perhaps, inflation as we get the jobs and the unemployment situation, sort of back in order. There still remains a fundamental problem. You have a lot of parents home, because schools were closed. So we'll sort of see what happens when across the country the schools open up in the fall, if we get a lot more labor participation that way. Once the federal aid kind of starts pouring in, I think we'll probably see some more labor participation from that too. So those are going to be two interesting things to look at. But I think overall, it's a good read. It's a good read.
Anthony, we were talking about earlier, 16.6% of those employed were teleworked in the month. That's down from 18.3% in the prior month. What is the economic impact, if you're even able to estimate, of workforces going back into an office setting?
I think, Brian, it's a very positive development because, as you probably know, when people go back to the office, they spend money in restaurants, they spend money commuting. So it basically has a multiplier effect on the overall economy. Not to say that some people working at home is a bad thing, because we know that one of the reasons why productivity growth has picked up during this pandemic, which is, again, probably one of the greatest and dark secrets of everything terrible that has happened. The productivity increase is positive, but you don't want to have too many people working at home and therefore not contributing to the rest of the overall economy. Now, by the way, that increase in productivity feeds into another story as to why inflationary pressures over the next 12 to 18 months may also be dampened, because if you got more productivity growth, even if prices go up and even if wages go up, we're not going to see all of that translate into higher prices. So there are a lot of moving parts that you see in the things that have happened in labor markets over the last year and a half.
Sylvia, we see the initial reaction here in markets that, futures seem to like the report just a little bit. But I'm just curious how you're seeing financial markets against the backdrop of an economy that is still volatile, still recovering, but some of the vol within the data does seem to be settling down. And it would appear that markets are calming down as well. Are you seeing that as you look at the landscape here, for stocks?
I actually expect to see a little bit of sideways activity continuing throughout the next couple of months. I think part of the reason why we're seeing the volatility slow down a little bit in the last couple of days, minus the meme stocks, of course, is because people are sort of away and on vacation, and it's just kind of been a little bit of a doldrummy type of week. But I think the markets this year are different than they were in years prior. In the last decade, you could almost have invested in anything and you would have done fairly well, particularly the growth stocks and things like that. This year, I think we're looking at a market where you have to be strategic. So I think if you're a short-term investor and you want gains and returns and, stellar earnings quickly, you're going to have to look at sort of the hot reopen trade, right? You have all this pent-up demand. And I think travel, airline, cruises, getting back to life in America, I think that's what's really going to play out in the next few months. And probably the, level 2 medium-term hold that'll play out will be financials when we do see rate hikes. But longer term, the FANG stocks are still kind of beat up. I mean, a lot of them are below their 200-day moving averages. And I think that, I remain bullish on those names. I think that they're going to be longer term investments now that pay out with sort of more steady returns, so you're not going to get that's perhaps stellar 700% in a year pop on a name like Tesla. But I do think long term, when it's beaten up like this, it's a name to look at. So, the reopen trade in the short term, sort of everything else longer term. But yeah, I mean, we're in the second year of a bull market. 86% of names beat on earnings. I do think we're in an economic recovery, and we'll start to see positive returns in the market later, throughout the year, as long as inflation doesn't surprise.
Sylvia, getting back to some form of new normal life, whatever that might be, is that good or bad for the meme stock trade?
I don't think it matters. I think it's a beast of its own. I think what's really interesting about that is just that, it sort of signifies the massive shift that we've seen in terms of who the investor is. The retail investor is very much loud and strong in this market. I think you have the next generation of traders. A lot of them are high school kids and college kids, and sort of, millennial Gen Z versus the, just straight strategic portfolio managers and hedge funds and, professionals that are into the market and they're sort of getting behind these movements and looking for a different strategy. I mean, in a way, this is a strategy, right? They're looking at the biggest short squeeze names. They're looking at, smaller floats and things like that. And then it seems like there's a social media pileup to get into those names. But I don't think it matters. I mean, I guess maybe, you might be making the point that if people are sort of busy and back at work, they won't have all of the time to do these sorts of things. But I think that this is a new market, and this type of trade probably is going to exist in some form. I mean, especially with Bitcoin and Dogecoin, and it's just transitioned so much into, sort of like that next generation and innovation trading.
So as we head into the summer, maybe those people are going to be back in the office. Maybe they're going to be on the beach and they're not going to be trading, or maybe they'll be trading on their phones. I don't know. Anthony, I'm wondering how you're going to spend your summer in terms of what economic data points you're going to be watching from here to see if indeed your hypothesis, and of course what is the Fed's hypothesis as well, about inflation being transitory, if that is borne out. What are going to be the most important data points to watch?
I think the most important data points, Julie, to watch are to see what the leading indicators of inflation are telling you. That is the expectations, whether I look at the TIPS market, whether I look at the consumer confidence numbers from the Conference Board of the University of Michigan, telling me what are the inflation indicators or expectations for the next year or many, many more years, looking in the credit markets to see what the five-year expectations are for inflation. In other words, what does the credit markets tell you that they expect inflation will be 5 years from now, 5 years into the future from there? So those are all indicators. Of course, the Federal Reserve has this very neat new indicator that looks at almost 24 economic indicators that measure inflation expectations. That's the shortcut. If you want to look at that, that is also going to be a very exciting indicator that tells you where the trend in inflation expectations is going. And if that basically continues to remain stable, and by the way, a little secret here, it has remained stable. And that's one of the reasons why the Federal Reserve thinks that the inflation pressures are transitory, because its very extensive research does show that inflationary pressures, when you go out beyond 12 months, it is in fact telling you things are in fact going to slow down. And then in the market, I think I'm excited that the market is up double digits, more than 10% for the S&P year to date. But that's based on forward earnings that the consensus is expecting close to a 36.5% gain in earnings. But when I look at what earnings are going to do in 2022, those consensus earnings are going down to about 11 or 11.5%. So you can't get the same kind of performance indefinitely that you're getting in a year where the consensus is telling you that earnings are going up for 2021 by 36.5%. We're not looking for that for 2022 or even probably 2023. So that's something that you have to somehow reconcile moving forward for this equity market, considering the fact that when you look at forward earnings, the price earnings ratio is still more than 20, about 21, a little over 21, and the average is 16. So all these factors, I think you have to take into account if you're an investor or even if you're an economy watcher.
Unless you buy meme stocks. No, I don't know. Anthony, thank you so much. Good to see you. Anthony Chan is the former head economist at Chase, and Sylvia Jablonski of Defiance ETFs. Thanks, guys.